way Charles Dow talked about it was he referred to the primary tides as these long-term trends that last for years, if not decades, and they're driven by one thing and one thing only. They're driven by fundamentals. So this is, again, Charles Dow drawing this link between the trends we see on a chart and the fundamentals that drive them. And what his greatest contribution, I think, to this to the field of technical analysis was this notion that primary trend cannot be manipulated. So that means that if the fundamentals are good, and everything we learn about the CFA charter holders, the CFA body of knowledge, and all those things that we try to bring to bear to find good fundamental trends. If in so doing, we discover a company that has good, strong fundamentals. Charles Dow, over 100 years ago, said that if those fundamentals are strong, that trend is going to go up. That price is going to go up. If the fundamentals are bad, that price is going to go down. And nobody can manipulate that. Nobody can change it. So an example of that we have today is the trend in equity prices in Japan. That market peaked in 1989, and it's been in a bear market ever since. And that's despite all of the things that the Central Bank of Japan has tried to do to rekindle the bull market over there. And it's basically a blank checkbook. Everything that the central bank has thrown at that market to try to get that trend, that primary trend, that tide, if you will, to turn, they can't do it because the fundamentals aren't there to support it. No matter, so if you're a central bank and you can't turn the tide, you know, you can rest assured that nobody can really alter this trend. So that was an important observation that Charles Dow put forward, that long-term trend is efficient. It will sniff out the best fundamentals, and it will sniff out the worst fundamentals, and all you need to do is listen. So the secondary trend is what he referred to as the waves, which are the movements of water that kind of shift back and forth on top of the tides themselves. These trends are driven by both fundamentals and emotions, and they last for months, if not years, so they're a bit shorter term in nature. These can be manipulated. So if you have a large money manager who's trying to exit his or her position, that added pressure on a stock in a given window of time could easily influence that price. But if the fundamentals are strong, that trend will recover and resume its trend again. So in the secondary time frame, these waves can be manipulated. And then lastly, what Charles Dow referred to as the minor trend, which of course are the ripples. If you can imagine the droplets of water flittering on top of the waves, which are then on top of the tide itself. These trends are driven entirely by emotional reactions to the fundamental data, whether it's right or wrong. And these can last for days or weeks, or sometimes even shorter. And these are almost assuredly manipulated. So you can see, like, a hedge fund might put something out on Twitter about how they're short Tesla or some other stock, and that may in that moment may drive people to emotionally respond to it. But again, in the end, the fundamentals will win out. So if that hedge fund that's short Tesla is wrong, which obviously they have been, because the fundamental trend in Tesla is so strong, a lot of us will probably hear that sentence and laugh at it. But the judgment of the market would say you're wrong. The fundamentals of this company are very strong. So this is a notion that Charles Dow put forward in the late 1800s, that the market is random, but it's also efficient. And again, we later find out, perhaps beginning with securities analysis, which was Benjamin Graham's contribution in 1933, I believe it was, as we begin to formulate and put into writing fundamental philosophy. This philosophy ties price trend to fundamentals, and it preceded much of what we know about fundamental theories today by 50 years at least. And so the idea is that price becomes more and more random as your time horizon shrinks, and becomes more and more efficient as your time horizon extends. So it's important as an investor trying to apply technical analysis, particularly if you're a fundamentally minded investor, that you're much better off focusing on those primary trends, because those are the ones that are driven by fundamentals, and just ignore the short-term trends. All the technical techniques that we use to measure each of those trends, they're identical. Trend lines, moving averages, all the different oscillators that are super valuable in helping us identify trends and time them and things like that. All those tools work across all these time frames. But it's important for you as an investor to pick which time frame you want to capture. Do you want to capture the emotional swings, or do you want to capture the fundamental swings? And most fundamental investors are obviously more interested in the primary trends. And so it's you just take these same tools that you would learn in the CMT curriculum and apply them to the primary time frame. And that's what I do actually. Okay, so let's move on here. So we've talked a lot about this notion of this link between fundamentals and technical. So over the years, of course, I've been doing this for 30 years, and I've sat in front of a lot of clients, a lot of students, trying to get them to appreciate this link between the two. And so what I've done over the years is I've developed this very simple sort of formula, if you will, that helps bring these three styles of investing together. So here you have price, you have growth investing, and you have value investing. That's essentially, in a very high level, those are the three ways you can invest, right? It's price, which is momentum, technical, there's growth, and then there's value. So as we understand those three styles of investing, they're very different. In fact, it's almost they're almost combative in their defense of each other relative to these other styles of investing. Like I'm a value investor and everybody else is crazy, or I'm a growth investor and value is terrible. It's like some of my worst decisions have been made paying attention to valuation. And then both of those, growth and value would scoff at price momentum as something that you could actually use as an input. But what we don't appreciate is that these three things are actually in the same formula. They actually coexist in the same formula. They're linked, right? So when you start thinking about it like this, you appreciate the idea that we're not independent of each other. All three of us, no matter what style of investing you're using, we're all working from the same formula, right? And you can even say that on the right side of the formula, there's another input over here, which is behavioral bias. So the way you could think about it is that price is just simply growth times value, or it's earnings per share times the PE ratio, right? Both of which on the right-hand side of the formula are influenced by behavioral bias. So depending on where you are in the cycle, there's either going to be a lot of optimism and your estimates are going to be really high, and your valuation that you'll assign to those estimates is going to be really high, which is your behavioral bias. Or we'll be in a bear market and your estimates will be much lower, and the amount that you're willing to pay for those estimates is going to be much lower. So you have a lot going on the right side of the formula, but when you look at it, you come to realize that all three of these styles of investing, we're all in this together. Each side of this formula needs cooperation from the other side in order to make money. So no matter what I think about the right side of this formula, as a fundamental investor, I'm not going to make $1 on that analysis until I get cooperation from the left side. Price has to go up, right? Now, that sounds like a very strong defense for technical analysis, but the reality is, as a technician, no matter what I think about the left side of this formula, I am not going to make $1 from that view unless I get cooperation from the right side of the formula. Something has to work over there. Earnings per share has to go up, valuation has to expand, or preferably both. And if we can get the kicker of behavioral bias kicking in as well, then just look at the formula. The left side of that formula is going to skyrocket, but it's not going to skyrocket unless I get cooperation from those inputs on the right side. So there is no right or wrong way to think about this. It's just you gotta appreciate that we're all working from the same formula. What I often say is that there's nobody on the planet, and I think I mean this literally. I haven't met everybody, so I can't say for sure, but there's nobody on the planet who believes in the right side of this formula more than me. I mean, I have my CFA, right? I studied finance and investments undergrad at Babson in just outside of Boston. So I mean, I believe wholly on the right side of the formula. It's just that I've chosen to focus on the left side of the formula because of the next 2 points that I'm about to make on this slide. It just matches who I am as an investor. It matches who I am as an investor. So if you look at this formula, as simple as it is, there's one big difference on each side of this formula is the degree of complexity. So if you're on the right side of the formula, and let's just say you click the G, that opens an entire Pandora's box of questions that you now have to answer. Growth, what are we talking about? Are we talking about growth in earnings per share, growth in market share gains, growth in revenues, expanding margins, all these different things that need to be addressed for every stock that you monitor from a growth perspective, right? And then you click on the V for valuation, and that opens an entire additional decision tree. Are we talking about price to earnings? Are we talking about historical price to earnings? Are we talking about next year, the next 2 years, price to sales, price to cash flow? What are we talking about? Price to cash flow. Do you and I even define cash flow the same, right? So this is an entire level of complexity that exists on the right side of this formula. And it's a whole, and they're all linked together, and it's a very complex series of questions that you need to address and answer when you click each of these two inputs. And then on the left side of the formula, when you get to price, when you click on P, what you get is price, because it never changes. That's the point, right? So that's the benefit of technical analysis. It takes this very complex series of decisions that must be made for every stock, and reduces it to one answer: price. So it's not like I use technicals exclusively, but I'm not saying you need to use technicals exclusively. But what you can do is use it for a guide, use it as a guide to help you make a very complex series of decisions, just to use it as a benchmark, that this is what the market says is right based on all these complex things I need to decide. What do I think, right? And so you can make a better assessment as to where your view is aligned relative to what the market is thinking. And again, it's unavoidable. This formula there must be cooperation within this formula for all styles of investing. So the benefit of technicals is just to take this very complex world and reduce it to a single answer, and it will be that answer forever, right? Because again, you can't restate price. And then secondarily, the difference in perspective on each side of this equations. And this is probably why I come out on the left side of this formula more so than the right. And again, I'll stress again, it's not that one is right or wrong. You just need to figure out who you are and engage with that part of the formula. So on the right side of the formula, if you come to work every day operating as a growth manager or value manager, you come to work every day working from the assumption that the market is wrong. Like the market's discounting X growth or thinks it's worth this valuation, I think the market's wrong. My assessment's a better assessment than the market's assessment, so therefore I'm going to press that bet. I'm not saying that's wrong. There are many great investors who have made a very substantial amount of money for themselves and their investors operating on the right side of this formula, assuming the market is wrong, right? You come to work every day operating on the left side of the formula, which is where I come to work every day. I assume the market is right. I don't argue with the market. I assume that the market's gone through this process, assessing for every single stock all these complex questions that need to be answered on the right side, and has come to this conclusion. I assume the market is right. Why do I do that? Well, because the market is pretty hard to beat, right? We can all pretty much say that the market's probably one of the best fundamental analysts on the planet, right? So the idea for us as technicians is that we've essentially, it's not that we disagree with whether or not fundamentals matter. We wholly and entirely agree that fundamentals matter. You can't look at this formula, no matter who you are, and argue that one of these three things don't matter, right? Clearly, fundamentals matter to a technician. The difference is that we have just hired the market to be our fundamental analyst, right? And we've done so because it's demonstrated itself to be a pretty good fundamental analyst over time. It's why it's so hard to beat. So all we have done as technicians is just checked our ego at the door. We pay this market a lot of money to be our analyst. We meet with it every morning and just hear their ideas out, and then we execute accordingly. That's how we think about it technically. We believe in the fundamentals. We just taking the opinion of the market, not our opinion.